Welcome once again, and we're looking forward to going through all this with you today in these 5 steps. So first of all, let's talk about a real quick historic background of what happened in the market. And we have to take a few steps back to understand this, because in order for us to fully get into hindsight and understand where we're at today, we really need to go back and search history to be able to understand what's happening. And some of this has to go back as far as 1980. And one of the things that happened in 1980 that has really caused a lot of questions is the way that interest rates performed during that time. You see, there was actually something that they did very interestingly to try to bolster up, and they were having some problems with spending and at the government level, which was causing inflation to go a little crazy. We're seeing a little bit of that today as well. But one of the things that they tried to help to resolve this was something that they called the Phillips curve. And in the Phillips curve, what they were doing is they were putting on the gas and pulling off the gas, pulling on the gas, pulling off the gas. In other words, raising and lowering interest rates to try to keep inflation at hold and at bay for a period of time. And this actually didn't work like they had anticipated, because interest rates ballooned. And in 1980, they were up in close to 13%. In 1982, they peaked at about 18%, which is pretty crazy. But here's something I want to be able to dwell on real quickly with this, and this is the reason why I went back this far, is because back at that point in time in the late 70s and early 80s, this is when all the baby boomers were actually buying homes. They were buying their first homes, and they were suffering through this interest rate hike and through an amazing situation with interest rates absolutely going nutty. And they saw a lot of inflation on homes during this time as well. And in fact, many of the banks nowadays are actually referring back to this time in 1980 as kind of a guide for what's happening currently with the market. They're actually seeing that the market is performing in a very similarly to the 1980, because we saw during the pandemic, in the 2020 pandemic, we saw the interest rates drop pretty heavily, and then we've seen in the last 12 months them skyrocket back up. So a lot of people are referring back to 1980 as similar to what we're having nowadays. Now, that's not entirely the case. We do have some similar patterns, but it's not entirely the case in what's happening right there. Fast forward to 1990, which is not listed on the slide, and at that point in time, Mr. Clinton, President Clinton, he was trying to make housing more affordable, and so he loosened up some guidelines at that point in time, which it eventually evolved into a situation that really got us into the crash of 2009, because they started being really crazy about the guidelines and how they were handing out loans. And that created all sorts of problems going into 2009, where 2009, that's where we had the Great Recession, 2008 and 9. And so these loose credit guidelines were actually creating all sorts of problems. And then we had that crash where 10% of America lost their home. Now, part of this, and the reason why I want to accentuate the Great Recession of 2008, 9, 10, 11, 12, 13, and those of you who were in real estate at that time fully understand what happened at that point in time, but there was a huge, massive credit crunch. Now, I was working for a builder at that time, and we were regionally building homes in the Richmond, Virginia area, and pretty much all over the area leading into the Central Virginia area. Now, one of the big things that came about of that is during the credit crunch, they completely cut our funding. We could not build a spec if we wanted to, because we just couldn't get credit. Now, that was a big problem. Now, 10% of America also lost their home during that time. And then what started happening in about 2010, 11, 12, right around 2013, 2014, the millennials, the leading edge of the millennials, were starting now to get into the housing market, as well as we were starting to see immigration double and triple as far as numbers and people coming into this country. Now, why is that a big deal? It's the whole reason why this is a big deal is because builders were not keeping up with inventory. We were about a million homes short every year since the crash of 2008. You couple that with the people who are now recovering from the crash of 2008 and now are eligible to get back into homes. You're dealing with a leading edge of millennials getting back into the homes. And then you have double, triple immigration coming back in. And that really is really causing a crunch when it comes to housing inventory itself. Now you fast forward to 2020 when the pandemic hit, then things were going wrong, very smooth. And I remember we were actually on a company trip when the rates fell out because everybody was scared because of COVID, and we had to get the rates back on track so that we could actually start getting the economy back to working. So the rates dropped down into the threes. People were going crazy. People were buying homes. People were refinancing. Crazy things were happening at that point in time. Fast forward to 2022, and then things started calming down. Inflation was getting out of hand. Home prices were getting out of hand. And then now all of a sudden, we're starting to get these rates start going back up. Now let's fast forward a little bit to today's view, and let's look at some of the stuff that's happening now. So as we got into today in 2023, some of these pressures that you've seen building over this period of time are still playing into what we're dealing with right now. The interest rate pressure is still there. We're dealing with low inventory now, but we're still dealing with steady demand, even though right now the competition may be a little bit reduced because of the interest rates. So it doesn't mean that the interest rates have gone away. It just means, or the competition has gone away. It just means that you have fewer people doing this. And we're going to look at some stats here in a little bit about how that looks on a national level when it comes to this. And we've also seen home appreciation. Those of you who are professionals in this industry already know that home appreciation has not slowed down. It may have gone from the 14 and 15% that we saw locally back in 2020, 21, and early 22 into a more normalized level, but it's still persistent. We're still seeing home prices go up. So what that means is, let's take a look at the interest rates and kind of see this graph real quick that was put together. Now, this is a slide that was sent to me by Buffini, and so I'm just kind of sharing his material here real quick. This material is as of June of this year, so it's a little bit behind the times, but this chart is actually very important because you can see that back in the 1980s, if you're looking at this chart correctly, they went by decades and 10-year increments. They don't actually have 1982 in there, which is where the peak of this was. Now, I remember, I'm going to give a personal story on this on my parents. My parents actually bought their first home in 1982, and that was in the midst of 18% inflation. They couldn't have picked a better time, right? 18% inflation, but the home price was in northern Minnesota, so that's a very rural area. It was $28,000. Now, fast forward, they kept that home. They still have that home. Fast forward from 1982 to 2023, guess how much that home is worth? It's worth 7 times what they bought it for. 7 times. They bought it for $28,000. They could sell it for 7 times that right now. Okay, now keep in mind that this is a conversation that's going to continue as we keep going through this conversation, going into where the market is headed and who the buyer profile is. Personally, I bought my first home in 1996 at the age of 8 because I was really young and really ambitious. Now I was actually probably 24, but at the age of 8, I'm just going to stick with that story. I bought my first home, and my interest rate back then, I mean, you look at the rates here, I was kind of halfway between the 1990 and the 2000. I bought it at 8.5%, and I thought I was getting something great. And I think that the message that is not getting out to the public right now is the message that you see in the top right-hand corner of this slide, where it says marry the house and date the rate. Because the same thing that happened to my parents is what has happened to me. Is I bettered my situation over time by being able to refinance as the rates consistently came down. If I had been smart enough at that point in time, when I was 8 years old, I would have held on to that first house, and I would have had a rental portfolio by now, and I would have had some great things working out. But I didn't do that. Now, having said that, look at the note on the bottom right-hand corner right there, where it says experts at Freddie Mac expect that now we're starting to see the housing market has stabilized from a sales and house price perspective. Now, that's a key point, because what that means is that while we saw 14 to 15% inflation, like I was talking about not too long ago on homes appreciation, what we're seeing now is that homes are leveling out about 4 to 5%. Now, that 4 to 5% is going to continue forward for the foreseeable future until what happens is the rates start coming down. And we're going to talk about that a little bit more in a second. because that's going to really speed things up. But before I go there, if you look at this, you can see the rates as they started coming down. The rates at 8.5% or 8.25%, which is kind of where we're at right now, on a historic nature of the last 40 years, this is actually fairly average as far as the rates. And so while we're hoping for 4s to 5s, and those will be coming sometime soon, this is kind of what we're looking at this point, is we are seeing that rates are going to continue at a very steady pace, and home appreciations are projected for 2023 to be right around 4.5%, and the projection for 2024 is around 5%. And so that means the following is that we really need to be understanding that the mindset of looking at just the interest rate is actually going to get us into a very difficult spot. So I put together this little comparison so you can kind of see what I mean by that. And so if you look at the conversation of rate versus appreciation, in today's column, which is on the left-hand side, we're going to make the assumption that you're buying a home at $400,000. You put 10% down with a $360,000 loan amount. At 8% interest, your principal and interest on this payment would be about $2,600, $2,641 and some change, okay? If we waited for the interest rate, which is projected to be at the end of 2024, somewhere in the 6% range, I just wanted to use a round number for round number's sake, so I use 6%. That is a little aggressive. I don't think it's probably going to get down that far to a flat 6, but it very easily could. If we put that assumption into 2024, that $400,000 house would have a monthly payment of $2,158 and change. Now, what that means is waiting saved you $438 per month. If you look at the fine print down at the bottom, about $11,596 per year. Now, I mean, that's what the common conception is, right? That's the common conception, is that that's going to save me $11,000. But did it really improve your purchase price or your purchase, or did waiting for the rate actually cost you more? And so this is where the rate versus appreciation conversation needs to come in, because the projection is, this is kind of what the projection is based off appreciations. Now, these are statistics from national statistics. These are not statistics based off of local markets or local areas. This is just on the national scale. And so if we took in 2022, we took this $400,000 home that we had in the previous example, and we had 9.6% appreciation, which is the national statistic. At the end of that year, that $400,000 home would be $438,000. Taking the same approach at 2023, that home would be $417,000. So you can see the appreciation is starting to stabilize, which is normal for a 3 to 4% range, right? 2024, the projection of 5% by the end of 2024, this home will now be worth $420,000. Now, this conversation is beautiful if the same exact home in 2024 was worth $400,000 as a home in 2022. The problem is that when you flipped over, you bought the home in the beginning of 2022, and you go to buy that same home in 2023, you're actually not buying a $400,000 home. You're buying the $362,000 home from the year before that now is worth $400,000. Does that make sense? And so in essence, the math is actually pricing some people out of the market, not because of the interest rate, but because home evaluations are going up. So keep in mind that this home, that as it's not the same home that was bought, and the only way that they're going to see these prices that we're going to keep talking about these things coming down is if we actually see something much bigger than the crash of 2009 in order to be able to get these down. Now, the appreciation piece is pretty significant when it comes to that. But let's go talk about the buyer profile, and then we're going to start drawing this in and bringing this together. So if we come into the buyer profile next, this is actually where we start understanding the parts and pieces of the different people as it comes into who is going to be the buyer out there right now. So if we go and look at the buyer profile and you look at the bottom left-hand corner, something that you see down there in the bottom left-hand corner is the percentage of cash. So these are the buyer profiles of the people who are out there buying homes right now. Notice that in 2022 and in 2023, so far year to date, that the buyer profile is that what we're seeing is that 25% of the transactions that are happening with buyers are actually cash sales. Now, this is pretty important to know, because that means that not every single, the perception is everybody's coming in and buying with cash, but this is actually not the case. 75% of all the home transactions are happening with a mortgage. So what does that mean? Perceptually speaking, for example, we just dealt with one over the weekend where they were trying to buy in a really nice part of town. And in this part of town that they were buying in, this home back in 2021 would have probably had 27, 28 different offers. But right now, the home only had 7 offers. It only had 7 offers. So your reduced competition is actually helping you. And every single one of the people were putting money down. And so they weren't all cash. And this was a very desirable part of town, which means that not every single deal that you're going up against is all about cash. Now, keep in mind, who are the people who are able to be these all cash buyers? If you go back up into the top right hand corner, you're going to see that many millennials right there at the top are finding themselves competing with boomers who are flush with cash after selling their homes that they in essence bought in 1980. Okay, at 18% interest. And so here's the interesting piece about this, is that this is no different than an investment in the stock market. This is no different than any other type of investment that we're seeing. It just grows with time. Now, why is that a big piece? Because if you look at the typical down payments down in the bottom right-hand corner, where it says typical down payments, you can see that the average money down on a home right now for any type of buyer is 14%. Now, that 14% is really telling you that it's not as heavy as, now this is a national statistic, it's not as heavy as what a lot of people feel like when they're going out to compete. The challenge is that sometimes what they're trying to do is they're trying to go in to compete with some of these boomers who are flush with cash, or in some of these harder parts, these more desirable parts of town. And in jumping into these desirable parts of town and also other places like that, they're seeing significant competition that they would not have seen otherwise. And in doing so, they're going with a 6% down payment against somebody who can, in essence, do a little bit more than that. Now, if we go to the next piece on the buyer profile, we're going to see something that's actually very, very insightful, in my opinion. Because what we're going to see here is we're looking at the demographics of who is our competition if we're going out with buyers right now. If you are a buyer who is going out to buy a home, this is a list of who your competition is right now. Your competition is, if you look at the purple ribbon down at the bottom left and bottom corner, your competition is your typical millennial who's buying their first home. They're coming in to buy. Now, millennials, what I have seen with millennials is that they are coming in and they're very well educated. They're getting very good salaries, but they're just starting up into their foray into housing. And so many of them are just simply not able to compete with some of the boomers who have sold, who are being able to put a significant more money down. So that means that, strategically speaking, some of these first-time homebuyers may have to strategically set themselves up for maybe not necessarily getting the perfect home, but maybe trying to find a way to get into something that makes a little bit more sense. Now, if you look at some of these other things that are happening, the number of first-time buyers that are in the market right now, that's 28%. So we have 25% who are buying with cash. Okay, that's 1/4. And then we have about 1/3 who are first-time buyers who are trying to get into this market. Now, the average age of the repeat buyer is going to be roughly in the 59 years old area. Now, this is pretty important, because what's the difference between those who are going to be in the 35 to 36 age range and those who are going to be in the 59 age range? They're not looking for the same product. They're really not looking for the same product. But in some cases, they are competing against each other because of the lifestyle features. And so if you look at what the buyers are looking for, which is in that right-hand column, you're going to see that what they're looking for is quality of neighborhoods. So if you're looking for some of these neighborhoods that are more desirable, like have some walking features, maybe have some parks nearby, have some nice features where you can get around to different lifestyle pieces, those are going to be extremely important. In fact, that's the first thing that most people are actually looking for in this market is 49% of people are actually looking to see if they can if they can get a better lifestyle in the quality of neighborhood. The second one that plays a really good, important piece here as well is convenience to family and friend. And I'll share this one from a very specific standpoint too. My son decided to move to Florida in 2020, right as the pandemic started. He decided, see you later, Virginia. I'm going to Florida. We're going to just kind of get out and enjoy life and just be away. Create a new place, create a new space, create everything. Well, in 2021, he moved back. He and his wife moved back to Virginia because there was no circle of influence. There was no family. It was really hard to try to do the things that are so important when you have family and friends around that you don't have in a new location. That's actually what we're seeing. If you remember the whole the work remotely kind of mandates and all those things that are happening, that pushed a lot of people out of the market and into different spaces. And now they're coming back because they really need to get back with family and they need to get back with friends and with their circle of influence. Now, this is what the buyers are looking for right here. And then nearly half of the buyers don't want to do some major renovations. And so strategically speaking, if you look at this and what your buyers are looking for here, this is where the vast majority of your competition is going to be for your buyers. And so if you're going to be buying a home, maybe you need to, if this is your first home, maybe you don't necessarily need to go into the most premier area, but maybe the second one, or maybe the convenience to family and friends is the higher priority. And so you start finding something a little bit more rural. But the third piece right here, which is the new home buyers with renovations and repairs, that's another piece where we're seeing some people being able to make strategic choices to help them get into these homes. Now, the challenges that we see for buyers are very simple right here. The home prices are still a challenge. Inventory is always a challenge. And then the rising interest rates as well. So now let's go into look at the seller profile real quick, and then we can set up a strategic conversation on how to make this work. Because in the strategic, on the seller side, things are slower than they have been in a while, but it is still tilted in the seller's favor. And so the favor, what they're seeing is if you look in the median number of offers received in that middle box down at the bottom, every home, according to this, is getting at least 2 to 3 offers. Now that's much better than 2021. In 2021, every home was getting 10 to, I remember, when I sold my house in 2022, we had 35 offers. I mean, I only have one house to sell. So, how do you get past that? But the offers are down, but there's still competition when it comes to buying these homes. Now, look at the box over on the right hand side. This is counterintuitive because I thought everything is going overpriced, everybody's paying more, everything's happening that's crazy. But if you look at this, the percentage of properties sold at above list price, that's only 25%. Now, if you 25%, if you couple that with the cash offers, now you kind of know who's doing what to get into these houses. Is you're seeing cash offers or people who are going crazy on these things to try to get them up and above this. Now, look at the main reasons for selling that you see in the top right-hand corner there. 21% want to get closer to family. It's the same reason that the buyers are trying to get closer to family too. It's one of the top reasons. They're moving due to retirement. Now, this is a new one. This is a new one. We're injecting a new piece in here. Remember the 59-year-olders, 59 and a half is where the first section of retirement starts, and then they can move out from there. So notice what you're seeing right there. Neighborhood becoming less desirable. I actually have a personal experience with this with one of my clients where they moved into an area that they thought was going to be tremendous. And after being there a year, they're like, we're done, we're moving out. We don't like the neighborhood. The neighborhood has not turned out to be what we thought it would be. We're completely moving out. So this is actually a really good opportunity if you're looking in that neighborhood or you're trying to get a listing, checking in with if you're a realtor, checking in with some of your past buyers who may have moved into a neighborhood and maybe don't necessarily like it. Or the last one right there is a change in the family situation. And so these are pretty important pieces right here. Now, the median distance, you can also see that based off of the demographic of the age there as well. Notice those in the 55 to 74, they're moving way out of town. They're just getting the heck out of Dodge and they're going somewhere else to have fun. So This is pretty important. Now, let's talk about some of the important conversations and kind of what to expect. And so this is where we get into the piece right there of what to expect. So looking at tomorrow's situation, we are going to see a compounding effect happening. Appreciation is going to continue. We are going to see homes continuing up in rate. Interest rates for the foreseeable future are going to be they are going to be on their way up, and we're actually expecting, believe it or not, the Fed has actually announced that they're going to be raising interest rates possibly 2 more times this year, once in the November and possibly in December, depending on how inflation goes. And so this it's very possible that we could see the interest rate pressure to be continued and continue to be elevated, but there eventually will be a decrease. There will be a decrease in this. There's going to be a direct proportion of how much negotiation pressure you have between the current interest rates and when these interest rates start to improve. And so this is going to be very interesting to see how this turns out, because the sooner those rates start coming down, the more inventory is going to be coming out on the market. And the sooner these rates come down, the more negotiation pressure you're going to be having, because you're going to be going with against the grain, against additional people who are going to be trying to get into these homes. And so this is a really important pressure point to spend some time on and to understand the dynamic of it. So let's talk about the forecast. Now, this is what we all wanted really for the whole thing. So everything else up until this is really historical value. But right now, here's the forecast for what we're expecting. Number one, in forecast for 2024, interest rates are to be remaining elevated initially. And so we could possibly see these interest rates continue into up 2 more times, possibly even more than that, depending on what happens with inflation. However, there will be a decrease on the horizon. Most of the economists tend to agree that once this becomes a very politically charged season, which everybody's probably heard that there is an election coming up, that once this becomes politically charged, it's very, very, very likely that this will turn into something much bigger than what can be controlled, and it's possible that we could see the interest rates start coming down. We're going to see, at least for the first half of the year, we're going to see inventory remain tight initially. And so it's going to be a matter of trying to stay in front of sellers and make sure that you're catching the eye of the seller, especially if you're a buyer trying to get in there. We're going to talk about the strategies here in a second. Expect interest rates and inventory to improve. I don't foresee that happening in first quarter. It could happen as early as late second quarter, but the real forecast is that it's probably going to start really significantly improving sometime after second quarter. Expect competition to heat up with that improvement, and then home appreciation will begin to accelerate at the same point in time once that happens. And so I think that I personally believe that rates are going to be modestly floating down, kind of like what we've seen currently with the Fed moving the rates up. We're going to see the Fed continue to do this in a very slow nature. We're going to see the Fed start moving these interest rates down on a very slow nature as well, and to where they get back down to a more normalized rate, or what we consider to be a normalized rate, by late 2024 and possibly into mid 2025. The forecast for mid 2025 and further out is somewhere in the 5s, give or take. Now, this is where we get into the strategic talk. So if you're really looking to buy a home, if you're a buyer that's looking to buy a home in 2024, or if you're an agent who is a real estate agent on this call as well, there are some strategic calls that are strategic pieces to make sure that we pay attention to as we're getting into this. The first one is whether you're a buyer looking to buy or you're an agent that is representing the buyers, you need to build a competent team. And so here's what I mean by that is the days of anybody's aunt or sister or nephew or niece representing you, if they don't have adequate negotiation skills to be able to help you, to guide you to buy this home, you really need to find somebody who's going to be able to help you do this. And this is an extremely important point, because the more skilled you are in getting the seller's eye, the more likely you are to be successful in buying this home. Okay, so and if you're looking at this as a loan officer looks at it, when the interest rates do start coming down again in 2024, end of 24, end of 25, there is going to be another refi boom. The reason why this is important if you're a real estate agent is, or a buyer, is because that means that a lot of these loan officers are going to go back for the easy money, which is going to be the refinances for all the purchases that they helped out in the last 2 to 3 years. You need to be making, whether you're a buyer or a real estate agent, you need to understand how that impacts you and your ability to close and help people move into their home on time. And if you're a buyer, you need to know whether that helps you move in on time or not. And here's the reason why I say this, is some entities have a first in, first out, and some entities have the one with the moving truck wins. Okay. And so here's what I mean by that. In a refinance, there's no moving truck, there's no pressure, there's nothing else going on with this. But with a purchase, you have a moving truck and you have a very specific set date that you need to be moving into this. And so making sure that you're building a competent team around the ability to perform and to negotiate is going to be extremely important. The next point is understanding your competition. We just went through buyer profiles right here. And understanding these buyer profiles is going to be extremely important so that you can understand who might be the demographic that you're competing with on this, realizing that 75% of all transactions still are going to be required a mortgage and a down payment, and figuring out how to compete. And here's what I mean by that. I have actually helped people who have not had the top offer win by how they present their offer to the seller. And so this is a very important piece, and we're going to deal with that in the next slide. The next one is understanding the seller's needs, because every seller has very specific needs. If they're moving to Florida to get into the sunshine and get away from the cold, that's a very different motivation than somebody who is just trying to move a little bit closer to family. Somebody who's only moving 21 miles away and needs to be closer to family. Understanding and digging deep on what that seller's needs are is going to be extremely important. And so when it comes to understanding the seller's needs, if you're a buyer, understanding the net, and real estate agents understand this, what this means is you have to make sure that your purchase price, that your contingencies, and that your guarantees are all set up in a way to where you're catching the seller's eye and you're presenting the best possible outcome that you can physically stomach in order to be able to win this bid and be able to get this house. Now, we're going to get into a little bit more of that in just a second, but these purchase prices is not always the only thing that really drives this conversation. Purchase prices are important, but sometimes it's having the no contingencies and some guarantees in place as far as being able to make this work. The next thing is understanding the listing strategies that are being used. Currently, what we're seeing in the listing strategies is that sellers are listening to their real estate agents very closely, and what they're doing is they're actually taking advantage of what's called the auction effect. And so they're listing the homes actually lower than where market could be so that they can get a lot of attention and so that they can actually get more buyers to come out, because once they get 2 bids on the table, now they have multiple bids. They don't have to disclose what those bids are, but those bids are on the table. And in essence, what's happening with those bids is that now they can put fear into your mind if you're a buyer, making sure that you kind of jump in to make more out of this and possibly even elevate your offer even further. Now, just keep in mind that only 25% of all offers are actually over asking price. So you have to work, once again, coming back to a competent team, understanding your real estate agent, taking their advice, understanding how to best set yourself up for success with that. And just understanding that you really only have one chance for first impressions with this seller. And so making sure that you have a top-notch offer and that it's extremely clean, that you have staged your offer in such a way to where you can present it and it makes sense, and that they can be clean with the seller, and that you time it so that you have the opportunity to make the best first impression. And the sellers are going to be doing the same thing. They're going to be trying to have a top-notch clean house with a very well staged, magazine ready kind of setup. And you can see that they all release these homes at very specific times. They release them at very specific times because that's when people start looking for homes, is usually on Thursday. Offers are due by Monday. You get a whole weekend to be able to get out and do these things. So as a buyer, understanding those positions and setting yourself up for that success is going to be extremely important. And relying on a very competent team to help you and guide you in that is going to be extremely important. Those that just realize that if the seller is not doing some of these things, that they're not, that the house is not top-notch clean, it's not staged perfectly well, it's probably not timed and released well, that you may have an additional opportunity with this house to be able to get in, because you may be dealing with an agent or a real estate agent that's not nearly as savvy as the one that you picked to be on your team. Okay. Now, the last one that I have on this specific slide is having an intimate understanding of your numbers and the variables. And I can't emphasize this. I can't emphasize this enough. It's extremely important for you to know, number one, what your top number is. Number two, if there are homeowners associations, how are the taxes paid? How are the insurances paid? What are the different pieces with this? And what are the variables that you can play with in order either to secure this home, to have some flexibility to bid above the price and try to beat out the competition, or other factors like that. And understanding your numbers are extremely important. When it comes to understanding your numbers, you need to have a very good relationship with the loan officer so that you can sit down in very important times and go through these numbers and understand that the variables and how each one of these switches based off of your offer on this house. And I'm going to get into that a little bit more detail in this next section. So when you get into doing the offer for this home, it's extremely important that you're not just thinking about this as a black and white offer, instead that you're actually trying to negotiate perceptually. And what I mean by that, by negotiating perceptually, is that you're really trying to catch the eye of the seller, like I've said before, and perceptually remove any of the risk that the seller might feel with your offer, while at the same time mitigating some of your own. So how do you do this? So, once again, going back to the sellers are using the auction effect on this, this is where you have to kind of play with the numbers a little bit, because some of it's going to come down to how much money do you have. And if you don't have money to burn, which you can see that most of the people that are buying 75% of every home that is purchased, they don't have money to burn. They're actually comparing with other people. So I put together a real quick loan example here to kind of help understand what this means. And this is something that's very important here, because when you're dealing with the appraised value, this is where this typically comes in with the appraised value. And what I like to do when it's coming to this specific piece with a client is I like to have, if they found a home that they're very, 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 very in love with, I try to have a three-way phone conversation between myself, the real estate partner that they've selected, and then also themselves. And because I want everybody to be on the same page. What I want to do is, we're using the $400,000 example from previously. So you can kind of see that right here as we're looking at the 400,000. What I want to do is I want to understand with that real estate agent where this home could realistically and reasonably, what would be the range of where it will appraise. Now, we don't know exactly where that is because the appraiser is the one who actually determines that. But we want to put a range together. And I've done this so many times with people, and it works great. In fact, I did this with one person who only had 5% down, and she actually took a calculated risk based off of this conversation. She bid up and she won, and the home actually appraised higher than what she actually put her offer in at. And everybody else was too scared to actually go where she did. The home in her case was listed at 285. And when we met with the client, I met with the real estate agent. What we did is we pulled all the comparables from the area. We looked at everything that was around it, and we guesstimated that the home would appraise somewhere between 310 and 320. based off of the comps of everything they had closed in the last 90 days. We eliminated some of the comps that didn't look like they were going to match, and we put it together in this. Now, she was very tight. She only had 5% down to be able to make this work. But we figured that if what happened if the home appraised for less than 315, which was her offer, and it came down to 310, her perceptual risks to her was really $5,000. And that $5,000 in this case was enough for her to be able to either get a gift or to reduce her down payment down to 3% and still make this transaction work. So I put together this loan example right here to kind of go through this. Let's say that the home can reasonably appraise, that the home is being offered somewhere in the 380, 390, but we feel like the home could reasonably appraise between 395 and 400,000 and 410,000. Okay, so in this first example that you're seeing here, this is where the home fully appraises at the list price with them putting 10% down. Okay, now I use 10% down as a metric in this case, but in this case, this is a real example that truly can work. With this, the home was purchased, the offer was a guaranteed price to the seller. They took a risk in this case. They guaranteed the seller that they're going to pay hell or high water. They're going to be paying $400,000 for this home. Now, they have only 10% to put down. They don't have anything extra. The interest rate, 8%, and the monthly payment, $31.0155. Their cash to close, $51,979, based off of this home meeting appraisal. Now, when the appraisal came in at 395. Now they have guaranteed the seller 400,000. So what do? Do they have to come up with an extra 5,000, or can they float forward with what they have? The answer is they can float forward with what they have, even though the home came in under appraisal. Notice the cash to close is the same. Notice interest rate is the same. Purchase price remains the same. Here's where the difference comes in. Okay, this one is $35 less than this one in monthly payment. The cash is the same. The reason why this is important is if you go up to the more information button right here, you can see that this one right here, both of them have mortgage insurance, but this one has mortgage insurance that is higher. The reason is because from the bank's perspective, they're not putting 10% down now. They're putting less than 10% down, which drops them into a different threshold for the mortgage insurance. This allows us to add a little bit of mortgage insurance to this, which in this case is $35. It changes their payment by $35, but nothing else changes. Nothing else. The cash to close remains the same. The monthly payment is the only difference, and that's $35 a month. So from the buyer's perspective, they were able to perceptually negotiate with the seller and say, we're guaranteeing 400,000, and their risk was a $5,000 risk. Okay, now in their case, it was a $5,000 risk, but it really was not a risk as far as any additional cash. It was just in $35 extra per month. Now, what does that mean to them in total cost? If they refinance in 12, let's say 24 months, that $35 times 24 months is only $840 of additional risk. Does that make sense? Because that actually helps the seller take what they feel is like a guaranteed number, regardless hell or high water. I'm getting 400,000 on this house. Now, perceptually, that's what you sold to the seller. From the standpoint of the buyer, they're taking a calculated risk of 5,000 to maybe nothing, because we ran the comps, we understood exactly what we were dealing with. We had a three-way conversation, we showed them the numbers, and in the end, they were able to make a decision and win the home. So these are parts and pieces of things that can be done. The next thing is the inspections. I don't need to, real estate agents, all about this, about what to do with inspections. You homeowners that are on this call, this is actually fairly important. You need to look at these inspection items, and obviously you don't want to have a crumbling foundation. You don't want to have a heating and cooling system that is falling apart. You don't want to have the major items falling apart that cost you an arm and a leg. And unfortunately, in the case of my son, in the house that he bought downtown, we'll just leave it like that. We had an inspector go in, and this inspector obviously didn't know what he was doing, and he missed $40,000 worth of work. It was a total travesty. It was really rough. I helped my son. Actually, we had to jack up the entire second floor of the house and rebuild the wall going out on the back patio. It was terrible. So you need to make sure that you're limiting your exposure, but at the same point taking a calculated risk, because if you don't do that, somebody's going to beat you out with it. And so understanding what those are is going to be extremely important. And this is where you once again have to have a very competent team that you can lean back on. And part of that competent team is a home inspector who can help you with this and make sure he doesn't miss like what happened to my poor son. So that's a pretty big deal. Another one is close dates. And so the close dates on these are actually pretty important too. For example, we've actually been able to win people homes by offering a 14-day close date, because the seller had a domino effect. They were moving out of town. They were moving to another place, especially think about the demographics. You got an older one who's semi-retired or retired, and they're planning on moving into another area, or they're building a house, or there's something else going on. Doing a little bit extra digging right here sometimes can help you set aside. And this is getting back to the net. How do you get to the best possible piece for the seller so that the seller can feel comfortable accepting your deal over somebody else's? And so these are really important pieces to try to help you have the strategic conversation and to prepare in taking calculated risks. Now, I'm wrapping up the conversation right now. So for me, what I'm going to share next is a little bit about my business model. My business model is very different than most of my counterparts, and I'll just kind of share this here real quick. I actually work 100% by referral. I don't do like a lot of my counterparts. Most of my counterparts, they're paying for partnerships, they're buying leads, they're cold calling, they're doing all sorts of other things. I work 100% by referral because I really want to devote myself to you and to your clients and to you as a client before, during, and after each transaction. The reason why is because relationships are extremely important to me. And I feel like if I can do that, I can be better at what I do, and I can give you a higher level of service, and I simply can get you places that other loan officers can't get you. My only ask with that is that at some point in time that you refer me somebody comparable to yourself. And that's my business strategy. So I certainly hope that works for you. And that's really just kind of that's my 2-minute spam on exactly how I work. Next thing that I do want to share before I open up the lines for questions, if there are any questions, because I'm sure I haven't covered everything to your liking, but if there are questions, I'd be happy to open that up, is invite you to my first time investor class. I have a first time investor class that is coming up in about a week. The QR code that you're seeing on your screen actually takes you to the registration for that class. We would love to have you come to that class if you can make it. This is designed for first-time investors, and what we're going to be doing is we're going to be talking about the finance model, the rental model, and the management model. So how do you find one? How do you finance it? How do you pick a client? And then how do you manage it? So if this isn't you, that's entirely fine. No worries there. I just wanted to offer it to you in case you have somebody or would like to come to it yourself. So please please come and visit. And anyway, thank you so much for participating. I'm going to go ahead and open up the lines here real quick in case somebody would like to ask a question. If not, it doesn't hurt my feelings if you have to roll. We are at the limit of time. I told everybody an hour, and we're about 4.5 minutes away from that. So I made it. Just go ahead. If you do have a question, go ahead and unmute yourself, and then we'll certainly have a conversation around whatever it is that you'd like to talk about. Fantastic. I covered everything so beautifully well that everybody's either stunned or in amazement at how stupid I was in doing it. The good news about this is that what I'm doing is that we are recording this for perpetuity. So we're going to be uploading it to YouTube, so you can go back and look at it if you feel like it would be helpful. Otherwise, what we'll do is we'll have you'll be able to point and say where I was wrong. So anybody have a question?
No, but we'd like to appreciate your time, buddy.
Yeah,
Thank you very much.
Thanks for coming out. I appreciate you coming.
I have a question, Chris, about the part of what you said, build a competent team. Can you hear me?
Yes, I can. Go ahead.
So as a buyer, can build the team, but you mean as a buyer need to find a realtor that is in a good team and understands that negotiation and all of that. That's what you mean.
Yeah. So what I mean is there are a lot of agents, there are a lot of real estate agents right now that are falling out of this business right now because they're not very good at their trade. And they need to find somebody who's very good at their trade in order to be able to make sure that they have success in buying this first home. I know there are a lot of real estate agents on this that I highly respect, that including yourself, that do this business on a regular basis. And this is stuff that is extremely important for the buyers to know, is that they really need to have somebody who is competent. You don't have to have done it for a million years, but you need to have somebody who's good at what they do and has the ability to negotiate on your behalf, because that's really what you're paying your real estate agent for, is to negotiate for you and then also to secure the outcome that you're looking for.
Okay, yeah, this is a great class for us realtors, of course, and I mean, I would really like to understand more kind of negotiation in this time. So if you could come up with some more of these or recommend some classes or, you know, stuff like that that we could take to be able to prepare in order to prepare for times like that. I mean, upcoming times.
Sure, I'd be happy to. I'd be happy to connect with you offline with a couple people and some books that might be of help to you, and certainly help you get there. And I'm certainly happy to talk through some of the strategies I've seen. I've seen some of the agents work, and some of you folks who are on here who are realtors would like that as well. Or if you're homeowners, you're certainly welcome to join me as well. We can set something of that up. If that is of interest, you'll have to send me an email so that I know that you want that. And my contact information is right down here on the bottom of the slide. Would be more than happy to set up a mastermind between everybody who would like to do this, and try to get everybody on the to really know how best to set them up and set their clients up for long-term success.
Okay, Chris.
Okay.
Thank you. Thank you very much.
All right. 1 minute. Anybody else?
Chris.
Yes, ma'am.
This is Gwen. How you doing?
I'm very thankful. How are you, Gwen?
I'm good. Listen, quick question. You know, when you were talking about the 5,000 floating out there and it only changed by 35 in real estate language, would that be similar to when we add the appraisal gap?
So yes, but what I'm in essence doing in this case is you've promised the seller that you're going to be getting this 400,000. In essence, you've guaranteed the seller that hell or high water, whatever this appraisal comes in at, I am guaranteeing the 400,000. Now
Right.
That can be extremely scary for the buyer to say that I'm going to be doing this. And so while we call it the appraisal gap in real estate, they don't understand that. That's shop talk. They don't understand what gaps mean. And so for us, what we have to say is that, yes, you're guaranteeing it, but in this case, because of what your plans are with putting money down, it only affects your monthly payment by $35 a month. It does not change your cash to close. It's only your monthly payment. And that's a strategic move It is a strategic move to help you secure this home. And in essence, what you're doing is you're taking a calculated risk to do so. And so in this case, it's a 5,000. You would call it a gap appraisal, but in the mind of the buyer, they're guaranteeing the seller that 400,000, and the difference to them is $35 a month. And if they see it that way and they understand it that way, it makes it more palatable for them to take the gloves off, so to speak, and to go out and fight their way to victory and buy this house.
Okay, thank you so much.
Any other questions? All right, well, I would love to organize a mastermind for those who would like to do so. So if you go ahead and copy my contact information, send me an email. I would love to organize that, and we can get together and start going through some of this data together to help you be the best you can be in 2024 as a real estate agent. And if you as a buyer would like to be participating in this as well, you're certainly welcome to come to these events. So just send me an email, let me know that you want to be a part of this, and we'll get you set up. Also, don't forget the first time investor class that's coming up. Love to have you there. And I'm going to let you all get back to family. Thank you so much for coming tonight.